So let's say you want to go for a vacation this year, or buy a new car over the next few months, or even purchase a house 2 years later, or save up to pay for your higher education or your wedding. Where should you invest money for your various short-term goals? Everyone keeps talking about the magic of compounding with mutual funds and SIPs in the long run, but we still need money for various short-term goals because we need to live our life and pay for various things along the way. So in this particular video, I'm going to share with you 6 investment ideas for your short-term goals. Hello everyone, if you're new to the channel, I'm Udayan Adhye. I've been licensed in the financial services space in India since 2015 and I've helped over 1,000 families make better financial decisions, and through my YouTube videos, I'm sharing all my years of experience. So first up, let's say you need money in the next 3 to 4 years. I will walk you through an example of buying a car, but it could really be anything. So let's say you need 5 lakhs saved for the down payment of that car. Now I'll enter 5 lakhs in my master financial calculator, which by the way you can get for free using the link below the like button. So we need 5 lakhs in 4 years, and let's say the inflation is about 8%. Now in that case, the inflation adjusted value is 6.8 lakhs, and in order to get there, you have to invest about 12,250 rupees. I have assumed a 7% return here. Let's say move it to 9%. And in that case, you need about 11,700 rupees saved every month. But where should you invest this? Are stocks or equity mutual funds a good idea? Ideally, no, because the chances of losing money are higher when you are investing in the stock market for a shorter period like 3 to 4 years. This risk of investing in stocks goes down with longer time frames. In fact, let me share with you a few numbers around this. The Indian stock market has given annual returns of under 8% over any 3-year period since 1999, about 35% of the time. And out of that, you would have actually lost money 30% of the time over a 3-year period. And I've considered an 8% return here since that's what other safe instruments would have given over a 3 to 4 year period. And knowing about the chances of these negative returns is super important. I mean, just imagine you're saving for the down payment of a house and you need, let's say, 20 lakh rupees for it. So you invest that in the stock market thinking that it will be 20 lakhs or higher. But when you actually need that money, the stock market is low, and now instead of 20 lakhs, you have about 15 lakhs. That's what actually happened in the Indian stock market in the early 2000s, when the stock market's 3-year return was minus 18.5%. So I'm going to share 2 better investing ideas with you for your short-term goals between 3 to 4 years. The first is an equity savings mutual fund. It's a type of a mutual fund, as you can tell, that invests in stocks, bonds, and arbitrage opportunities. It does invest in stocks, yes, but the allocation to them is very low. So even if stocks are volatile and risky in the short run, the bonds and arbitrage investing makes these funds safe. The average 3-year rolling return of the 5 largest funds in this space is 11.8%. Let me show you the portfolio of the ICICI Prudential Equity Savings Fund, which is the largest mutual fund in this particular space. So you'd see it's investing across different assets where about 20% is in equities, 15% is in debt, a very small amount in real estate as well, but a lot of the money, more than 60%, is in cash or cash equivalents, which means it could be holding just cash that is not yet invested, or it could also be holding arbitrage opportunities in this fund. Now this fund has generated returns of more than 11% in the past 1 year, and if we say zoom out, over a 3-year period, the annual return is about 9%, and over 5 years, about 8.7%. But then if you notice, during the COVID crash, this fund actually dropped in value. So can equity savings funds give negative returns? Let me again put this in numbers. Since 1998, you would have gotten negative returns in equity saving funds on 2 occasions. The first time was during the dot-com bubble crash in the early 2000s, when these funds fell by about 1%. And the second time was during the COVID crash of 2020, when they were down by about 4% for 1 month. Now it's important to know that these falls were much lower than the overall stock market's fall, which fell by about 50% in 2001 and almost 40% in 2020. So while these funds don't offer fixed returns, they carry a minimal risk for an investment over 3 to 4 years. That's why you can consider them if you're okay with handling that slight volatility. And I personally like the equity savings funds from ICICI Prudential, HDFC, Kotak and Tata. You can also consider a conservative hybrid fund for a goal that is about 3 to 4 years away. This kind of a fund invests about 10 to 25% of its money in stocks or equities and the rest in bonds. Here, the small allocation to stocks provides an injection of growth, while the bonds add stability to the portfolio. The average 3-year rolling return of the top 5 largest funds in this space is 11.3%. Since 1998, conservative hybrid funds have also given negative returns 2 times over a 3-year period, just like equity savings funds. The first instance was in 2008 during the global financial crisis, when these funds were down by about 1%, but the overall stock market had crashed by almost 60% at the time. And then in 2020, during the COVID crash, when they were down for about 2 months by 4%, when the stock market had again tanked by almost 40%. So once again, their returns are not guaranteed, but the odds of negative returns are very low over a 3-year period, and that's why it's important to have that 3-year horizon while you're investing in either equity savings funds or conservative hybrid funds. And in both those instances, the fall was not a lot and it did not last for a long time. Now, since both these funds carry a similar kind of a risk and return, the way they are taxed becomes important while deciding which one to invest in. It's important to remember that equity savings funds are taxed like stocks. So you get 1 lakh of tax-free gains every year if you hold them for more than 1 year. And post that 1 lakh, you have to pay a 10% capital gains tax on the profit that you make. And if you sell them within 1 year, you pay a flat 15% tax on the gains that you've made. Conservative hybrid funds, on the other hand, have a higher taxation. If you sell them within 3 years of investing, the gains are taxable as per your income tax slab, which could be very high. If you sell them after 3 years, the gains are taxed at 20%, but after considering indexation, which just means considering inflation. First up, let's look at how taxation affects the returns on a conservative hybrid fund. Let's say you've invested 1 lakh for 3 years and that has grown at 9% annually. Then that investment has post-tax given returns of 1.25 lakhs. As you can see, the actual gain is 29,000, you pay a tax of about 3,800. On the other hand, with an equity savings fund, the same kind of investment made over 3 years would have post-tax become 1.29 lakhs. And that is because the tax that you pay here is 0 because the total gains that you have made are less than 1 lakh. Now remember, this 1 lakh is across all your investments. So if you have sold any stocks elsewhere or mutual funds elsewhere, that would be considered, and if that is beyond a lakh, then you'd have had to pay a 10% tax on this, which is about 2,900 rupees. Even in that case, equity savings funds are actually better in terms of taxation for 3+ year goals. And that's why even I would personally invest in equity savings funds, because I'm in a higher taxation bracket, and this taxation bracket, in case I want to redeem my money earlier, also becomes beneficial. Now on to investment ideas for a shorter time period of anywhere between 90 days to 3 years. So let's say you are planning a vacation in 2 years and you need 1 lakh rupees for it. We'll again use my master financial calculator. So we'll enter 1 lakh in our calculator. 2 years to go. Let's keep the inflation at 8%. And now we need 1,16,000 2 years later. Let's say you're getting an estimated return of 8% this time. For that, you need to invest about 4,500 rupees per month to hit that 1.16 lakhs. Now, for such shorter goals, it's very, very important to factor in safety, because there is no way that the money that you've invested should reduce in value. In that case, I have 4 investing options for you. The first is a good old fixed deposit, safe, and you know exactly how much money you're going to get. For example, let's check out HDFC Bank's fixed deposit rates for a 2-year period. So the 2-year returns are about 7% if you're not a senior citizen, 7.5% if you are a senior citizen. It at times could be beneficial if you have a senior citizen family member to invest in their name, but don't burden them just because you want to get 0.5% interest by having them pay higher taxes. One more option that you have here is recurring deposits if you want to invest that money monthly and not as a lump sum. But the 2 biggest issues that I have with RDs and FDs are that, first up, the interest that you get on them is taxed at your income tax level. So if you're in the 30% tax bracket, you could end up paying very high taxes. For example, let's say you invest in the HDFC Bank FD, which is 7% for 2 years. For an investment of 1 lakh, that would grow to about 1,14,490,500. But over that 14,000 rupee interest, you'd have to pay 30% tax, which means you are giving away 4,000, 5,000 rupees just in taxes. That's why your annual returns then drop lower than 5%. So that's the implication of taxes. They can eat into your returns big time. So FDs are a good idea if your income is not taxable or you're in the 10% tax bracket. Secondly, FDs and RDs are not at all flexible and they're very illiquid. So if you need that money before the tenure ends, then you have to break that FD and at times even pay a penalty for breaking that FD. Having said that, I am aware that there are a few now new age platforms that don't have this penalty at all, but you again have to register with them, so that becomes an additional process. Then you can also opt for small finance bank fixed deposits where you get about 0.5 to 1% higher interest than regular banks, and they're safe since they're insured up to 5 lakhs under the depositor's insurance. But I'm not a huge fan of trying to over optimize your investments for small amounts or open new bank accounts just so that you get 0.5% extra interest on an FD. That's because the difference of that small higher interest is going to be negligible, especially for less than 3 years. In fact, if you go to my Master Financial Calculator and we change this to 7%, you'd see that the total monthly investment that you need is literally less than 100 rupees. Whereas if this goes back to 8%, it would be 4,468. So I just don't think it's worth over optimizing your short-term investment interest so much. Now, I personally don't prefer FDs or RDs because they are very rigid and have high taxation. To solve this rigidity and illiquidity problem, you can consider even a high-interest savings account. There are some special bank accounts that give an annual interest rate of over 7% on your savings account. I'm putting up some examples on the screen, but keep in mind that a lot of them require you to have a large deposit amount to get that higher interest. Instead of any of these, I would consider either arbitrage mutual funds or short-term debt mutual funds for my short-term goals under 3 years. Now, to understand how arbitrage funds work, I'll share a real-life example of an arbitrage opportunity. So let's say you want to buy apples and in the store next to your house, you get apples for 100 rupees per kilo. But if you walk 5 minutes away, you'll get the same apple for 95 rupees. Now there's a difference in price between the two markets. So if you buy apples for 95 rupees and sell them to the store next to your house, you end up making a profit of 5 rupees. In the same way, the fund managers of an arbitrage fund take the advantage of price differences in the spot and the derivatives market. I know these are technical terms and I'll make a dedicated video on it soon to explain how arbitrage funds work. But because of this, what's important to know is that arbitrage funds have never given a negative return over a 1+ year period in the Indian stock market. And their average 1-year rolling return in the past 10 years is 7.5%. A short-term debt fund, on the other hand, is a type of a mutual fund that invests in bonds. For example, here's the ICICI Prudential Short-Term Fund, which has generated 8% returns in the past year. It manages over 18,000 crores as well. Now, this particular mutual fund invests in various kinds of bonds. The highest holdings are government securities. So if you notice, you'll see the percentage of interest that is given by this particular paper. And if I scroll down, you will see other private companies here as well. By private, I mean they're publicly listed, but they're not owned by the government. So LIC Housing Finance, Muthoot Finance, and again, they have 1.64% holding in this particular portfolio. In this category of short-term debt funds, I like the funds offered by HDFC and ICICI because they are very large funds and have been around for a very long time. And the average 1-year rolling return of short-term debt funds in the past 10 years is 8.4%. Now tell me in the comments if you want me to make a video on how to choose these debt funds, and I will make it soon. Now, given the almost 1% higher return in short-term debt funds than arbitrage funds, they become the obvious choice, correct? Wrong, because both are taxed very differently. Arbitrage funds are taxed like equity funds or the way equity savings funds we saw were taxed, whereas profit from short-term debt funds is entirely taxed at your income tax slab. To know how taxes affect returns, I have made a handy Excel sheet, which by the way, you can get access to using the link below the like button. So let's say you've invested 1 lakh rupees in a short-term debt fund and an arbitrage fund. In that case, the average 1-year return of a short-term debt fund is 8.4%, which means post-taxes, if you're in the 30% tax bracket, returns of 5.88%. Whereas in arbitrage funds, it's not dependent on your income. After the first year, there's a flat 10% taxation. So in that case, you get a return of 6.7% and have about 1.06 lakhs instead of 1.05. Now, remember, if you haven't sold any equity investments in 1 year, this essentially becomes zero. So then your post-tax returns actually are the returns that you get for your fund. So that's why I personally prefer arbitrage funds. We'll again just go through a couple of calculations of different tax slabs and till what point are arbitrage funds more efficient. So if you notice once again at 20%, they are very similar. So if you are in a lower tax bracket, then short-term debt funds can be a good idea. But for higher tax brackets, arbitrage funds would be the way to go. And finally, if you need money in less than 90 days, you can still consider a short-term debt mutual fund if you want to really optimize and maximize your interest. But if you want to keep things simple, which I really believe in, just keep that money in a simple savings account. Check out more resources in the description, and I'll catch you in the next one.